Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name is Manpreet, and welcome to Through the Noise. Now, you don't need me to tell you about the extent of volatility markets have experienced in recent days since the US announced reciprocal trade tariffs following a self-proclaimed Liberation Day. Now, when I look back over the market volatility, two things really stand out to me. One is just the unusual level of uncertainty that investors are facing today, given a lot hinges around US tariff decisions, as we just learned through the 90-day pause and the market flip flop that followed. The other one, of course, is what's proving to be a mixed bag of correlations. Bonds worked really well as diversifiers until they didn't, but gold, the yen, and Swiss franc continue to work well as safe havens. So, how should we as investors approach markets given this unusual level of uncertainty? To discuss that and more, today I'm joined by Rajat Bhattacharya, who's the senior investment strategist at the CIO office. So, welcome, Rajat. Let's jump straight into it. So, all this market volatility, in your view, is it time to sell, buy, or just hold?
Hi, Manpreet. You're right. As you mentioned there, risk assets have been extremely volatile this week after US President Trump paused reciprocal tariffs on over 75 countries for 90 days, while at the same time escalating tariffs against China. The volatility in the market shows policy uncertainty, not fundamentals, remains the biggest overhang. Now, this is certainly not the time to sell. In fact, in these times, we often tell our clients, and it's worth repeating, time in the market is more important than timing the market. Apart from the safe havens such as the Swiss franc, Japanese yen, and government bonds, interestingly, conservative and balanced asset allocation strategies have helped investors ride out the latest storm with relatively low volatility, underscoring the benefit of a sound foundation portfolio. Alternative strategies offer low volatility as well. As Wednesday's sharp bounce in the market showed, investors risk missing out on some of the best days of the equity market, hurting long term returns if they sell or remain on the sidelines. As markets get whipsawed, sharp drawdowns in risk assets are actually presenting some bargains in our preferred sectors. We add US inflation protected government bonds as a hedge against tariff driven inflation, and gold remains a hedge against stagflation risks.
Thanks, Rajat. Amid everything that's going on in markets, what are you watching for next?
Yeah, the flip flop in US trade policy remains the primary driver of markets. The uncertainty overshadowed a still resilient US job market report, which came out late last week. Now, the focus now turns to the trade negotiations between the US and its key partners, with Japan, South Korea, Vietnam, and India reportedly amongst the first in the queue. However, the trade war with China has escalated, and developments here will be increasingly important.
Okay, I wanted to discuss scenarios next because that's one way potentially to think about how events could play out from here. Given everything we've discussed, in your mind, what's the base case scenario?
Yes, I agree. The scenario-based analysis is the best way for investors to go, look forward. So we expect as our base case an economic soft landing in the US as Trump bows to investors, voter, and Republican Party pressure and seals deals with key trade partners. This week's volatility, followed by the policy U turn in the middle of the week, underscores the so called Trump put. In this scenario, growth falls below trend, but the US avoids a recession as the Fed cuts rates by 50 basis points in the second half of the year. Meanwhile, focus shifts to tax cuts and deregulation, helping risk assets recover by the year end. Under this scenario, the S&P 500 index is expected to end the year around 6,200 and the US 10-year bond yield around 4 to 4.5%. The S&P 500 target, by the way, is based on historical 9-month returns after at least 10% drawdown from peaks since the 1970s.
All right. What about a downside scenario? What could trigger that, and what does that look like?
Yeah, in the downside, there is this rising risk of slower growth and higher inflation if these negotiations fail and some tariffs do come into effect. The Yale Budget Lab did some analysis, and their estimates show that the Liberation Day's tariffs, if they are reimposed after this pause, would raise average US tariff to around 22.5%, which would be the highest since 1909. The short run impact would be a 2.3 percentage point additional rise in US consumer prices, a zero point 0.9 percentage point cutback in US real GDP growth, and a half a percentage point rise in the US unemployment rate. The impact of higher US tariffs on inflation, consumer and business confidence, job markets, and corporate earnings could lead us to a mild recession as the Fed holds off rate cuts due to the near term inflation spike. In this scenario, the S&P 500 index is likely to retest the key level of 5,000. The US 10-year yield could fall to 2.5 to 3%, and the USD index, which is the broad dollar index, falls below its 3-year range, below 100, especially if the rest of the world avoids a recession. A 5 to 10% managed depreciation of the Chinese yuan is an upside risk for the dollar, though, especially if other Asian currencies also depreciate with the Chinese yuan.
All right. And what about the upside scenario?
Yeah, in the upside scenario, successful trade negotiations and monetary and fiscal policy stimulus in China and Europe are the possible catalysts. Now, US policymakers then shift their focus to tax cuts and deregulation away from tariffs, while China's top policymakers boost domestic consumption and cut lending rates and bank reserve requirements. In Europe, Germany's incoming government could decisively boost fiscal policy, lifting the euro area's potential growth outlook. In this scenario, the S&P 500 index ends the year around 6,650, the US 10-year yield between 4.5 to 5%, and the dollar falls as non-US growth improves.
All right. Thanks. I think that's a useful way to think about it. Maybe a couple of final questions before we close today's podcast. One is, you mentioned looking for bargains in this environment. Where do we find those?
Yeah, given our base case scenario of an economic soft landing, we would look to add to our preferred sectors within a diversified allocation on any pullbacks. Now, these include in the US, the technology, software, and communication services, which have significant pricing power, and the banking sector, which should benefit from Trump's deregulation. In Europe, the banking sector should benefit from the domestic driven cyclical growth due to fiscal and monetary easing, and the industrial sector benefits from Germany's fiscal stimulus. And in China, the high dividend paying non financial state owned enterprise sector should benefit from policy support, whereas the Hang Seng technology sector should benefit from the AI developments as well as the government policy to promote the sector.
All right. And second, maybe how do we think about protecting portfolios against, the risk that we get heightened volatility in the days ahead?
Yeah, gold is the obvious one. Although we should acknowledge that the people it is subject to forced liquidation when other markets are suffering losses. I think to better hedge against further portfolio losses, the short-dated U.S. government bonds look well as they closely track market expectations of Fed policy, and they could serve as a hedge if the U.S. Sees a real slowdown. The European and German government bonds also offer a good hedge in terms of a broader economic slowdown, global economic slowdown. Among currencies, the Japanese yen and the Swiss franc have proven to be the most effective safe havens. While the Swiss franc has advanced the most Amid the sell off in risk assets, we prefer the Japanese yen given expectations of further Bank of Japan rate hikes. And in terms of the defensive equity sectors in developed markets, they might offer little protection in this kind of environment. But India's consumer staples sector has notably done well. Also, US tariffs on India have been milder than expected, and valuations are more reasonable following recent corrections. The large domestic market, consumer market in India, makes it a likely beneficiary of any investor outflows from China as and China trade tensions intensify.
Okay, well, I think that brings us to the end of time available. So we'll bring the conversation to an end there. Thanks very much, Rajat, as always. Top three takeaways from today's conversation. Number one, it may help to think in terms of scenarios of how tariffs and hence macro and markets are likely to play out, especially when you face such heightened uncertainty. Second, of course, in a message to start hunting for bargains, but of course, spread across US, European, and Asian markets, not just concentrated opportunities alone. And third, of course, to think about protecting portfolios against heightened volatility and staying diversified. So, thank you, listeners, for staying in today's conversation. We hope you found that interesting, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.